Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Forward stock splits are a way for a company to legally manipulate its price downwards without actually losing value. Now, why would a company actually do this? The answer most of the time is because they believe their stock price is too expensive for the average investor. Let's go through a real-world example to understand this a little bit better. In 2014, Apple stock was trading around $650 per share, which is quite expensive for a stock. And just for context, most company stocks trade somewhere between $30 and $100 per share. To bring down their stock price without actually losing any value, Apple performed a 7-for-1 forward stock split. Let's look at the math to understand this a little bit better. Assume an investor owns 100 shares of Apple stock at $650 per share prior to the stock split. To figure out what the change looks like, let's utilize something that I call the stock split factor. To find the stock split factor, go back to the stock split numbers and divide the first number by the second number. In this case, we'll divide 7 by 1 and get 7. That is our factor. Now, take that number 7 and multiply it times the number of shares and divide it by the price per share to figure out what the change will be to the investor's portfolio. The customer will end up with 700 shares of stock at $92.86 per share. The investor will end up with more shares, but each share will be worth proportionally less. The overall value of stock the customer starts with should be the same number that they end with. This customer started with $65,000 of Apple stock and will also end with $65,000 worth of Apple stock. If you don't end up with the same overall value of stock in the end after the stock split, your math was wrong.